The video you're about to watch is what should have been a live recording of my first ever webinar, but as you'll see very early on, things really didn't go to plan, and it was really disappointing. However, I think that the general content is not just useful for the audience that should have been there live on the day, but actually for anyone that's thinking about commercial real estate investment in 2025, because I'm reflecting on whether now is the right time to get into commercial real estate investment. And it's not just my conjecture. What I've done through the webinar is provided a little bit of information on particular types of commercial property that I think could still be good in 2025 and onwards, and perhaps types of commercial property that you should consider just pausing on and not necessarily jumping into quite yet. I hope you find the video helpful. If you've got any questions, you'll see my email and contact details in the description below. In the meantime, thanks a lot. Enjoy the video. Bye-bye. Hello, good afternoon. Welcome to the webinar. You should never ever start anything like this with an apology, but that is what I have to do. I'm absolutely gutted. I made a mistake and nobody was able to join the webinar live, which frankly is really heartbreaking because so much effort goes into the background technical preparation for a webinar like this, especially when you're relatively new to it like I am. I can see exactly what I did wrong. It's really simple but really frustrating, so I hope you find this recording as helpful as attending the event live. So with that said, I'd like to frame the context with which I am approaching all of the content and material I produce surrounding this issue of commercial property investment. You see, it starts with this book. And about 20 years ago, I had this idea in my head that I would be a day trader, that I would have a phalanx of computer screens in front of me showing different bits of data and information, and that I would get up nice and early, place my trades for the day, then go off and be a man of leisure, swimming, cycling, running, doing what the hell I wanted to do, come back at lunchtime, check in again and find out that I was a multi-millionaire many times over, and then repeat that the next day. So I bought this book and it cost $80. So it was a bit of a commitment. But what I found out about 3 to 4 chapters in was that trading of any description like that really would never have suited me. It was never going to work for me. I didn't understand certain graphics that I was being shown, but more than that, it just didn't align with me. And I was really angry because I bought that book and it was a lot of money. But very quickly I came to realize that actually spending $80 on that book was something to be grateful for, because it had probably saved me thousands and thousands of pounds that I invariably would have lost over a period of time. And that's always stuck with me, and it is a genuine lesson. It's something that I have gained a lot from, and I thought, right, well, what I'd like to do with commercial property investment in supporting any investor who's considering commercial property investment is to allow them access to information at a price that makes a lot of sense. So explicitly, if you're thinking about commercial property investment but you're not sure it's for you, any material I produce should be able to help you make that decision on a reliable and informed basis, but not cost you anything, or potentially cost you no more than £100. But right now what I want to do is address this issue of, is now the right time to invest in commercial property? And the reason for flagging that is that last year we obviously had various geopolitical scenarios brew up. And at the beginning of this year, with the advent of Trump and his tariffs, that continued unsettled global economic situation has really put the cat amongst the pigeons. And commercial property, unlike residential property, typically demands a substantial investment on behalf of the person that is actually pursuing that activity. So let's just frame some specifics. First of all, I am talking to, and the purpose of this webinar is to support individual investors who are considering a direct investment in commercial real estate. So the price point that you are probably entertaining is in the region of 100, 150, 200,000 pounds, all the way through to something like £1 million to £1.5 million. Asset value, building value. All right, let's look at some information that has been produced by the RICS. This is the Royal Institution of Chartered Surveyors. So this is from their Commercial Property Monitor. It's produced on a quarterly basis, and I've literally just screen grabbed the first 3 bullet points. Pay attention to all 3, but in particular, look at the 3rd bullet point. Average property, all property average projections for rents and capital values marginally positive for the year ahead, although expectations remain weaker across secondary assets. I think that this reference to secondary assets is a useful marker for us for the purposes of this presentation. So, weaker expectations. So, we're looking at assets with a value of circa 100 to 1.5 million, and they are probably in the regions or on the fringes of major urban centres. I would say it's safe to assume that trends for secondary assets at the very least will apply to those types of asset. So expect weaker for this year. That's the first headline. Just bear in mind though that long-term performance of commercial property has always been strong. It has always been reliable. There are various definitions of what constitutes investment, but it is typically held that anything owned for over 7 years constitutes investment activity. Anything disposed of within the 1 to 7 year window is termed flipping or development activity. So you can see then a term of 7 years plus is actually a long-term commitment, allowing you to ride in and out of various cycles. And it's important to note as well that commercial property falls in and out of favour with investment markets. Just before we leave this data point alone, it is apparent to me that through my career I've worked with individual investors on a regular basis, but from time to time I've been retained and employed by some really substantial investment companies, in particular AIG, American International Group, FIM, which is now part of Gresham House, and most recently Head of Investment Finance for a property team at Legal & General. Those big organisations use data from those big commercial surveying houses, CBRE, Knight Frank, Savills, etc. And I've analysed those reports that are produced on a regular basis. And yes, Savills and CBRE have their own property research teams. And yes, they are of a scale where they can produce data for themselves internally, which has a degree of value, a very high degree of value. But what I've noticed is that all of the major report producing chartered surveying firms tend to get their data sets from one outlet, which is Oxford Economics. And they're all just rehashing the same data set to some extent. Okay, so what's my point? Well, my point here is that I cannot drill into the Oxford economics data enough to understand whether their definitions of secondary or tertiary include the type of assets that are the target of this presentation. So we're just going to have to take a general steer from the language that is used. Hence me drawing your attention to that RICS report that said about secondary assets being weaker. All right, I think we've done enough on data. Let's move on. Again, this is from the RICS. I don't know where they get their data from, incidentally, but this slide here I think is quite interesting. It's 12-month rent expectation, so it's a forward projection through 2025. Note the orange arrows. These orange arrows mark out secondary office, secondary industrial, and secondary retail in turn. The big takeaway, number one takeaway here is if you are investing in commercial property in the UK and you want to go with one of the three main recognised asset classes, office, residential, or, I beg your pardon, sorry, office, industrial or retail, then clearly I would say look at industrial. Over the years, industrial has been a very, very good long-term performer. There was a time back in the late 90s and early 2000s when it was regarded as a bit of a tortoise in the industry, not very exciting at all. I would say actually the industrial market, particularly that light industrial market where a lot of individual investors can gain some serious traction and gain good access, is actually one of the more mature areas now and a really, really strong contender for you to consider. So there's my number one takeaway. Look at the industrial markets if you haven't made up your mind. So clearly here then a note of caution surrounding secondary office and secondary retail. Let's just look at the office bit. It is absolutely imperative that you as an individual investor understand your local market and understand what the supply and demand requirements are for office accommodation. Have you seen when you're driving around lots of to let boards and for sale boards up on the side of office buildings that you're familiar with over the last few years? If you have, it would suggest that the COVID work from home cycle has probably hit those buildings very hard, and unless the trend really changes, we are seeing a bit of a change in London from the bigger companies saying return to the office, and that's definitely taking place. But unless we see that trend actually happen across the UK and we see a lot more people called back to office space in the UK, you know, it could be that those buildings continue to suffer for a few years yet. Talking of trends, especially with office space, there is currently a pattern of buying office space, getting the necessary consents if they're required, and converting them to residential accommodation. That isn't going to be a focus of this particular webinar today, but it is something that could be considered. I'm going to come back to refurbishment and development type work a little bit later on in this webinar though. So take care around office space and also take extreme care around retail space as well. Again, talking about trends, there is clearly a trend for acquiring retail property and converting the upper parts into resi. I'm not going to talk about that here explicitly, but what I would say from a commercial investment perspective, the regional UK high street is a turbulent and difficult place to read, and I would encourage you, particularly if you're a first-time investor, to probably steer clear. So my second takeaway is continue to stay away from retail high street investment unless you've done your research and unless you know there is going to be high demand for the type of property that you want to buy. because even if you have a tenant in situ, the pressure being placed on the high street at the moment is causing retailers and high street operators to fail on quite a regular basis. And so, yes, there is a benefit of having a commercial lease. They run for many, many years, but there is no benefit to having a commercial lease if your tenant is under so much financial pressure that they have to fold and walk away from occupying your building. So, takeaway number 2 is, for the time being, stay away from retail. It's not the right time. Okay, so I'm just going to flip on to one more screen. And this is 12-month rental expectations. So, and again, another forward look for rents on alternatives. Oh, I hasten to add, these slides are not showing you property values, but in both cases, they mirror the value slide. They are identical in terms of the patterns that are presented on the screen. A note of caution here, particularly if you're thinking about investing through a SIPP or a SSAS pension. This particular slide mentions certain investment activities that will potentially land you in hot water if you get involved with them with your SIPP or your SSAS. So, for example, it says multi-family buildings here. Residential property is a big no-no for your SIPP or your SSAS. There are some nuanced exceptions to that. I'm not going into them here, but just take care that if you're investing through your SIPP or your SSAS, you are definitely investing in commercial real estate. I want to pick out data centers here and life science. This is where, again, I do question whether data sets like this are aimed at individual investors or whether they're aimed at a more corporate investing audience, because there's a lot of noise around data centers at the moment. Google are recruiting for data center purchase managers, data center development managers, both here in the UK and in the Benelux region. Google and data centers, I would say, are of a scale that is typically beyond the range of a normal individual investor. Typically, individual investors or typically individual property players will get involved in the data center cycle a little bit further upstream, i.e. the land play. And this is going to be my third takeaway, is at the moment, don't be a hero. Now is not the time to be a hero. And what I mean by that is buying land with some sort of speculative planning upside that you can then flip, or buying that building that you've routinely driven by and thought, oh, I could do something with that. It looks beautiful. I can just renovate it or whatever. I would say now is not the right time. We are seeing build costs coming down because material costs are potentially coming down, but we still have a shortage of labour. And I would just say that the money markets at the moment are not going to follow a speculative planning or development play. So don't be a hero, go boring. I know it's dull, but boring is typically very, very good if you're in the commercial investment space. So that slide there, just out of interest, is showing, well, a little bit down on last year. I know that they are quarter by quarter comparisons, but it does look like a general slowing, and I wonder whether we will see that slowing in the alternatives market continue through this year. My fourth takeaway from this is that the slide refers here to alternatives. One alternative commercial real estate investment that is routinely overlooked and hardly ever mentioned, and I really don't know why, is commercial forestry. I am a huge fan of commercial forestry. It will typically require an initial investment north of £1 million. But commercial forestry, timber here in the UK is in high demand. We grow very, very good quality timber, and we are net importers of timber. It does look as if the housing market will pick up. So that supply-demand relationship between UK grown timber and the housing market is going to be positive for anyone who owns commercial forestry. Not only that, the year-on-year real returns are normally exceptional for commercial forestry. They have been continually very, very good for the last 20 years, and I see no reason why that will change. Finally, on commercial forestry, the tax advantages that are completely baked in and transparent, so completely legitimate, no clever sort of trickery or anything like that. The tax advantages of commercial forestry are just huge, really, really huge. If you'd like more information on that, please do drop me a message after you've watched this, and I will send you more information on commercial forestry. So that was takeaway number 4. Do investigate commercial forestry, particularly if you haven't made your mind up yet about what type of commercial property you want and your investment level is north of £1 million equity. We've covered off different property types there. The important notes to appreciate following on from that then is there is a real value in stepping back, step away from the type of property that you're thinking of buying and have a bit of a different view. Try and understand where it sits on the risk spectrum. So if we look at the risk spectrum here, or the risk line, you'll see that you have core assets at the beginning, going to core plus, going through to opportunistic and development activity. Core assets would include buildings that are new or require no work done to them at all, possibly even no work in seeking a new tenant. They are just there. They are oven ready and they're good to go. They represent a very, very low risk, especially a core asset of good quality that has a tenant in situ. Core plus, ever so slightly different. It is a very good quality asset on the whole, but will require either a very, very small degree of refurbishment or upgrade and or a degree of tenant or occupier adjustment in order to optimize value. So an example of Core Plus is this building here in Exeter, which I was instrumental in acquiring and funding back in 2017. I appraised the entire building when the opportunity became available and noted that the tenant mix internally, it's a multi-tenanted building, was not optimal. So that building was bought in 2017 for 7.2 or 7.3 million. And after adjusting the tenant profile and getting things really occupied in there to the max, the building was sold 2 years later for 9.3 million. Slightly bittersweet, that story, for me personally. And one thing I really want to note is, remember earlier I referred to true investment activity being holding of an asset for 7 or more years. And I would be interested to have seen what would have happened to that asset if it had been held for the true cycle that I had modelled, which was a 15-year hold, and just see whether the full value would have played out as I expected. Right, okay, so that's a Core Plus example. Opportunistic. This example on screen here is a sports hall. An agent whose mailing list I'm on pinged this through to me, and I think this is a really interesting one. The building's located near York. Incidentally, this is a live opportunity. Based on what I was saying earlier about don't be a hero, I would say this is definitely hero territory. So this is an opportunistic example. It's a sports hall. You can see it's in not a great state of repair and located apparently quite near a motorway, located near York. My immediate thinking here is that you construct some form of storage solution, self-storage solution inside this building, and then you run a storage business from that property. So given that you would need to get consent probably for the change of use, given that you're going to need to undertake quite a lot of development activity, construction type activity, there's going to be a delay in your cash flow, and storage in particular. Storage is scaled on an operational level, not on a sort of real estate level. So actually it's got its own nuance there as well. That is a really good example of opportunistic investment. That's hero territory. Stay away from it for the time being. And finally, development. This is real hero territory, and needs to be done very, very carefully in this day and age. This site that you can see behind me in this image is central in a market town in the southwest of England. Very much mid-tier socio-demographics, quite a strong financial community, I would say. Consent given for a retail operation on the ground floor, but it is big space, and consent denied for any use of the upper parts. So a false parapet has to be created above this new retail unit. It's just a complete pup. And this, I would imagine, has been financially killing the owners of this site for the last 3 or 4 years. So what's the point of running through that risk spectrum? Well, I said step back. Consider the building you're looking at with a fresh lens and think, okay, I understand the building really well. I know how I want to occupy it, but where does it truly sit on that risk spectrum, that risk line? Is it a core asset? Is it undeniably core or core plus? Or is it actually a little bit opportunistic? If on review you find that you're looking at an asset that is a little bit opportunistic, then bear in mind, if you need to get debt to purchase that building, the lens that your debt provider will use will be quite a harsh one. They're going to want to know that you have de-risked absolutely every element of that opportunistic property purchase. And also, if on review your opinion of the property you want to buy has now moved from core plus to opportunistic, you may well have to review your expectations of gearing, how much debt you're going to be able to get your hands on to purchase that property. It could be a lot less than you think. So understand that risk profile, particularly in this current geopolitical climate with the financial markets tumbling around as they are. We're not in recession yet. It's being threatened, but just bear in mind that right now things aren't perfect. They're not terrible by any means, but money is not going to bet on you. Money is a machine that wants you to make money for them. Let's put it another way. A bank is not there to be your friend. A bank is there to lend money and get more money back again. But that's the key thing. They've got to get their money back again in the time frames that they expect. So have a realistic view of the type of property you're looking at and make sure that you've got it absolutely pegged on that risk profile line. Okay, type of property. We've seen industrial looking quite strong at the moment. I've erred away from retail. Office could work, but you've got to know your local markets. And especially if you've got multi-occupier office, like that Senate Court example that I showed you, that could be quite exciting. Can you undertake some sort of active marketing campaign? Can you subdivide the space in a slightly better way and get more tenants in situ? So office could be a good one, but there's a fine line between office being a banker and office being a bit of a hero project. So you're going to need to exercise your discretion on that. Right, finally, owner-occupier. This is typically going to affect you if you are purchasing a property through a SIPP or a SSAS and you want your own business to occupy that property. Again, there's a huge need here to step back, take a look at the building. It might suit your business right now, but what's the exit plan? I've done a couple of videos on exit, making sure that you consider the long view, consider a disaster scenario of your business failing, or a potential upside scenario of your business succeeding and growing out of the space. But the flip side there is that you then have vacant space. So the building you're looking at as a purchase, as an owner-occupier, would it suit other tenants? It's not the end of the world if the building you're looking at is quirky. If it's been on the market for a long time and it's perfect for your business, that could still be a good thing. But what you're going to need to be aware of is when you begin to exercise your exit strategy from owning that building, you might need to press the button a year, 18 months sooner than you would normally expect to do in order to have a long ramp of marketing to get that building away. So we've covered a little bit of ground there. Let's just address the question though, is now the right time to invest in commercial property? Implied in that question is there a problem now that should legitimately prevent you from investing in commercial property? I think there are problems. I think it is taking a long time for people to secure finance, and I don't think that is being helped by the disturbance in the global economy and the financial markets here domestically in the UK. I think that means a lot more people are now going for different sources of finance, particularly private finance, so seeking debt from high net worth individuals, for example, which comes with its own issues. Again, probably a little bit too much to delve into here today in this workshop. So I'm not saying hold off all commercial property investment activity. I am saying take your time to do your analysis and your due diligence. Take your time to research thoroughly. Take your time to speak to professionals in the market and get their view on the particular property that you're thinking of buying. I'm going to echo what I've said earlier. Don't be a hero. Those projects that you think, oh, I can do something with that, I can make something of it, I think they're the ones at the moment that probably it's not the right time, just because I think there is too much difficulty out there at the moment in attracting solid funding at a good price and securing labour supply, and just not knowing where your cash flow may start or where it might come from. So there are assets out there that I think are strong contenders, particularly industrial at the moment. I think that's still a very, very strong market. All right, what I want to do, if I may, is just introduce to you a solution to a problem that I think exists. I have already referred to individual investors being largely underserved. So I've designed a service that is intended to be extremely cost effective and time effective. So that is exactly what I'm about to introduce to you now. I've called it a commercial property roadmap. So this roadmap will go through the process of starting out, understanding what makes a good property, going through the number work, analysis and appraisals, making sure that the property performs to your financial expectations. Going through alignment, ensuring that those appraisals meet the requirements and the expectations of your broader financial team, your SIPP or SSAS administrator, your IFA, your accountant, your tax advisor, and then the associated readjustments that may need to take place after they've had a chance to review. And then you move into the deal, the negotiation stage, and the extensive, heavy management stage of not just your own solicitors, but the procurement of reports and that sort of thing. And finally, you get onto the most important bit, which is always overlooked, and that is the asset management after you've completed the deal. How do you protect the rental increases? How do you protect the capital value increases? That's all through effective investment asset management. And And so the service I've created, this commercial property roadmap, allows beginners to go through those processes that I've just described, but also allows someone with a little bit more experience to jump in at the point they need the support, get the support from me, and then leave again with a big smile on their face. So I'm always there on hand to answer your questions, and I will keep you going through that deal process. I think that's the best way to go about things, because to my mind, if I give you a course and send you off into the wilderness to go and self-learn, I don't believe you'll get it done. It's really important to maintain momentum, because commercial property is difficult, and because it's difficult, I think it's really important that I'm there to support you and that I'm on hand. If that sounds like something you're interested in pursuing, please do send me a message. My email is on the screen now, and we will get in touch. In the meantime, thank you very much indeed for watching this workshop. I hope you've enjoyed it. If you've got any questions, please do email them through to me. Thanks a lot. Bye-bye.